Good morning, everybody, and welcome to this October Accounting and Corporate Reporting webinar, Tricks and Traps of Tax Effect Accounting. Now, I'd like to welcome a very special guest today, one of our directors in IFRS and Corporate Reporting from Melbourne, Cate Pozzi. Hello, Cate, down in Melbourne.
Good morning, Kevin.
Now, Cate is joining us
And
today
thanks
because...
and welcome. Yep.
Thank you. Cate is joining us today from Melbourne to present the majority of the presentation on tax effect accounting. The part of the reason for that is she has an absolute, almost irrational passion for tax effect accounting. So we're very happy to have her. I'll give you a brief rundown. Cate is, as I said, one of our directors in Melbourne. She has an extensive experience in accounting, risk management, and ethics. I've actually known Cate for a number of years, as we all have. Cate has worked at a number of the large and medium-sized accounting firms, as well as in business in logistics and banking. So Cate has some really extensive experience. Welcome, Cate. You'll also notice that Aletta is missing today. Aletta is actually across the ocean in France enjoying the Rugby World Cup. So for the first time in perhaps 2.5 or 3 years, we don't have Aletta in the room with us. And so we'll make some decisions without her today and move that along. So Cate, Cate will be driving the presentation today. She's doing most of the work. But we'll move on to the next slide where we actually put Cate and mine details up. I would also like to just do an acknowledgement to country for our Aboriginal and Torres Strait Islander people. In Sydney, I'm on the Gadigal lands, and in Melbourne, Cate is presenting from the Wurundjeri and Boon Wurrung lands of the Kulin Nation. So we'd like to do that acknowledgement and then move into our agenda for today. So the agenda for today, it is a tax effect accounting. Now, it's a really interesting presentation. Cate has done all the hard work pulling it together, and the way she's designed it, I really like. Instead of doing, shall we call it, traditional training on tax effect accounting, where we talk about accounting, carrying value, and tax bases, we'll take some of that stuff as read or as understood, but we're actually going to get into this and say, well, why is this of interest, and in particular, why the ATO would be of interest to this? So a little bit of development out in the industry there. And then move into some of the key issues on tax effect accounting, what's changed, what are the big issues with tax bases, and then dispelling some of the tax accounting myths that are out there. We'll end off with disclosures, and I actually quite like the way that the presentation is bookended between why it's important from the ATO and when the disclosures at the end. In other words, painting this or presenting this out there to your users and the public at large, because you will see as Cate moves on today that the disclosures are not just some techie type disclosure in financial statement, but they're actually really valuable insights into the way the business is run, the way tax affects the accounting, and the way tax is going to affect the entity in the future, because that is what tax effect accounting is. One of the key components, deferred tax, is really future tax. So Cate, I'm going to hand over to you today to take the majority. Yep. Welcome, and the floor is yours.
The floor is mine. So let's start with, why would the ATO be interested in your tax effect accounting? And if I call it tax accounting, that's because that's what I typically call it. It can be called either. So as a number of you are possibly aware, the ATO actually has an assurance program where it looks at accounts. It looks at accounts and it looks at, in this case, it's the top 1,000 entities. Now the top 1,000 is looking both at income tax and GST, and it's part of the tax avoidance task force. So they're looking through to look at what is actually going on. And it's focusing on the larger businesses with an opportunity to gain greater certainty about their tax outcomes and the effectiveness of their tax governance frameworks. The other point that the ATO makes in regards to this program is that it actually provides an objective mechanism for large businesses to understand how your tax profile compares to others in the market and their peers. Who's actually covered by this? A number of you probably are, because it covers the top 1,000 combined large public and multinational companies with turnover over 250 million. And it does also include taxpayers that the ATO was previously engaged with through its income tax and GST assurance reviews. The really key message to make here is we're going to cover what the ATO looks at, but it also is ASIC or other regulators who are looking, and that your tax disclosures are and will be used by others to assess your entity and compare yourself to other entities. So when we look, and this information has all come from the ATO website, it's interesting to see what the ATO is actually going to look at. So they start with your statement of taxable income and supporting work papers, but then very quickly they are looking at that reconciliation of your accounting profit before income tax and the profit before income tax and the tax return. Now I know that people do their accounts at a different time to their tax return, but it's making sure that there is a sufficient granularity to actually see and that people can explain the differences. Now they're not going to stop at that point. They're going to keep going and actually look through into your working papers. So particularly where we've got tax consolidated groups, looking at the group losses schedule. How have they been calculated, the transition up to the head entity? Your franking accounts, taxation of financial arrangements. And as Kevin discussed, I do have a background and I was involved in talking to the ATO from an accounting side when TOFA was actually being introduced. Now, when we get down to the tax accounting, and this is where the interesting piece is, because a number of the disclosures I read even in the last financial cycle, when we look at the reconciliation of taxable income, we get a lump number which is non-temporary differences. Great, but what is the detail in there? And that's what they're looking for. So a breakdown of the material non-temporary differences, a breakdown of the material items impacting deferred tax, amendments to current and deferred tax from prior periods, and why are they happening? As I said before, it's easy enough if the difference is to do with the timing of when your financials are completed versus when you're doing your tax return. But if the same differences are coming up every period, what is it that you're going to actually change in your processes to try and minimize those amendments? If unders and overs are always coming out, what is it? Are there items that you can actually do some work on earlier and get that actually working through? And the interesting one at the bottom is an explanation of why the effective tax rate is different to the headline corporate tax rate. We're going to touch on effective tax rate again at the end, but effective tax rate works on your tax expense, and remembering that tax expense has both a current and deferred component. So calculating your deferred tax is just as important as calculating your current tax. And the other piece, which is really where it becomes interesting, is making sure there is actually documentation of elections and choices made under tax law, and that's going to tie into how our tax base is calculated, but it equally works into just how you're doing things, making sure that we document year on year so that we don't actually keep on having to reinvent the wheel. And one of the points that I got from one of the tax partners that I work with is that even say in regards to tax consolidation, that we are starting to see entities who are not following their own tax sharing or funding arrangements because they were put in place a number of years ago, and the people who put them in place are no longer there, and people have forgotten or just ignoring what's gone on. So what's changed in tax accounting? One of the things which is sitting in the OECD has introduced Pillar 2 tax. It was touched on in the federal budget in May. The government has said it is going to be introduced in Australia, but the issue with Pillar 2 tax is it's not just going to hit the large entities. It is applicable only to large entities. At this stage, it's entities with revenue over 750 million euro, I think it is, so it's slightly larger than what an SGE is. But as we've found with SGEs, a number of entities in Australia are caught within larger groups. So you can be a very small entity in Australia as opposed to a large one. Now, where the pillar, and I'm an accounting person, I'm going to say that up. I know enough about tax to know that when you do tax accounting, you do it with an accounting person and a tax person. So if you want to know about Pillar 2 tax and whether you're potentially exposed, you talk to a tax person. I'll tell you how to account for it in accordance with AASB 112 rather than 12. And equally, there have been amendments to 1060 dealing with the simplified to bring in similar adjustments. So the impact of the Pillar 2 tax is going to play on entities with effective tax rates below 15%, and there's going to be a top-up tax. It's not just in the Australian arena, it's going to happen internationally because, as I said, it's come from the OECD. At this point, it's only been introduced in a couple of countries, so in South Korea, Japan, and the UK. So if there are any operations coming in, if the head entity is in any of those jurisdictions and or there is a holding company in any of their jurisdictions, it could become applicable. It could become applicable very soon. So what it will do is actually change the tax rates which are going to apply to both current and deferred taxes. But without the clarity of the actual laws, the issue, recognizing that when we're dealing with deferred tax balances, we have to look at the tax rates we expect to be effective when those deferred balances are going to reverse. We've not got clarity on how it's going to work, where it's going to work, etc. So the IFRS actually looked through it and made amendments to IAS 12 and said that entities are not permitted to recognise or disclose information about deferred tax assets and liabilities related to Pillar 2 income taxes. And this is a mandatory exception, but interestingly enough, for a mandatory exception, you actually have to disclose that you've applied it. From that point forward, we will disclose, when applicable, the current tax expense or income related to pillar taxes separately to your income tax. And in the periods when it has become enacted or substantially inactive, but not yet effective, entities will need to disclose the known or reasonably estimatable information that helps users understand the exposure to Pillar 2 tax. As I said, that is actually worked through such that one of the articles in the corporate reporting for this month will actually touch on the amendments to the AASB is actually just published to AASB 1060, which actually rolls through exactly the same disclosures. So entities doing simplified accounts will also have to comment if they have applied the mandatory exception in this case. And the disclosures in that case are effective from on or after 1 January 2023, which is the same with the AASB 112, but end on or after 30 September 2023. So it's not applicable for the entities who are still doing their financials up until the end of October for 30 June, but it will wash through into your next set of financial accounts. If you are in a group where this is potentially applicable, I would expect there to be guidance from your head office, but it is something that you should be talking with, because I have also seen with SGEs that some groups have forgotten to tell the Australian entity that they are an SGE, and as you know, anyone who's been anyone that's been applicable to knows that that means you have to prepare accounts and lodge them with the ATO. So regardless of whether you've got an exemption under ASIC because you are a small proprietary company, someone has to lodge them, and that works through, and that goes into the tax disclosures that the ATO is looking at and through. So who is impacted? As I said, it's expected to be annual global revenue of 750 million, which at the point that the budget was put together, that was approximately 1.2 billion Australian, so slightly larger than an SGE, but not much. But again, it's coming back to effective tax rates. If the effective tax rate in any of the jurisdictions is below 15%, there will be a top-up tax levied. The top-up tax is likely to be levied at the headco, when that headco is also subject to it, but the issue is going to be who accounts for it. That's still being discussed amongst the firms, and there's no positions yet, but interestingly enough, we already have a precedent with tax consolidated groups where it is the headco who is subject to the tax, but we have the UIG, the interpretation which actually allocates that tax expense down. So we'll need to watch that one. Now, what goes on with tax base? It's been an issue for a long time, but it continues to be around. And part of the issue is the fact that there are and can be multiple tax bases depending on the entity, how the asset is going to be used, whether the entity is in tax consolidation or not, whether an entity has been brought into a tax consolidated group. All of those can reset the tax base. So one of our first myths that the tax asset and liability and the accounting asset and liability will be the same. No, they're not. We can have an accounting asset. So we have a lease for accounting purposes. We have a right of use asset. We have a lease liability. Tax still works on the idea of hire purchase arrangements and operating leases. So the issue comes is that I can be talking about a lease from an accounting side. We're talking with the tax people. They know what their lease is, but we're not actually talking about the same asset or liability. So it's having enough knowledge to know when there are differences. Another thing would be our financing costs. We put effective interest rate in, they want interest. So it's working your way through. So no, there are some assets and liabilities will be true, but there are others where it's not. A key one that I see a lot when I'm looking at financials and questioning disclosures is if you're incurring tax losses, tax effect accounting really doesn't matter. I can definitely dispel that one. And the recognition criteria for deferred tax assets and liabilities are required whether you have a taxable income or a tax loss, and that comes straight from the standard. And as I've referenced a couple of times, that effective tax rate is being driven in part or a large part by the deferred tax expense. An entity incurring tax losses doesn't have to recognise deferred tax balances due to the probability of them being utilised. No, recognition of deferred tax liabilities is always required. There is no probability balance in that one. Only the recognition of deferred tax assets is based on probability. But if we look through the assets and liabilities that they've got on book, if you've got something like a right of use asset and a lease liability, one gives rise to a deferred tax asset and the other to a deferred tax liability. But clearly, both of those, that deferred tax asset and liability, are going to roll out on the same profile. So we would offset those two. So we recognise the DTA to the extent of that lease liability, and the net position on the balance sheet is nil, but we have actually utilised it. So it gets down to that next point, that deferred tax assets in an entity making deferred tax assets in an entity making tax losses, they are probable if they're expected to offset the deferred tax liabilities. So it's actually looking through and seeing what it is. And the last one is one I suspect most people are not prepared to say they admit to, but I know happens an awful lot, which is how we get these bulk numbers that says temporary differences. You can't fudge, you should not fudge the deferred tax balances to get them to balance. You should actually be able to pick up your employee entitlements, your lease liabilities, your other numbers, and reconcile them. Like anything, if you've done them correctly, you shouldn't need to fudge. Yes, there might be $1 out or two for rounding or 1,000, that's fine. But by fudging them, it does imply that the tax expense and the effective tax rate may well be incorrect. So there's a need to get in and actually understand them. It's something that can be done prior to year end and updated at year end, but it's working your way through.
Kate, I might have a quick comment,
Yeah,
if you don't mind.
go for it.
And I just want to kind of reiterate the point you've made in the myths. Traditionally, when we've come across deferred tax or tax effect accounting or tax calculations at an end of a year, and I'm talking more about my audit days, perhaps, than our advisory days, there really truly was this myth that if you had losses, you didn't have to do any calculations here. And I just want to reiterate that, because you can see from what Kate has got to say that well and truly, this is an important process and a calculation that feeds into your financial statements, which feeds into your effective tax rate, which now is actually feeding into the global move to make sure entities are paying their fair share. It's no longer just this ethereal technical calculation. And just because you got losses doesn't mean you don't need to be on top of it. That may be my biggest takeaway from the myth slide that Kate just had up there. So that's a really key important takeaway that I'd like to reiterate to our audience today, to start to treat tax as a significant system and control in the business, as opposed to just this Excel calculation that somebody does near the time of the audit. And even then you give it to the most junior person in the team to try and deal with, because they most likely won't have the necessary competencies on the two sides. There are two sides to this, and Kate has already made that point. There's the accounting side and there's the tax side. And sometimes you actually need competencies on both sides. That doesn't mean you need to know everything, but you need to know the people you can access to help you with both sides, especially on the tax side if you're an accounting professional, and likewise, especially on the accounting side if you're a tax professional. So I'd really like to reiterate those as key takeaways from Kate's myth slide today. It's really important that you take that on board and elevate that up in the organization. I'll give it back to you, Kate.
Thanks for that, Kevin. I definitely agree on that. And part of the reason I do like tax accounting is I do it with tax professionals, and done that for a number of years. Getting back to why would your tax base be different to your accounting base? Well, tax depreciation is based on statute, but accounting depreciation is based on useful life. It's highly unlikely that the accounting and tax useful life match. It might in some cases, but we do see people who, particularly in some accounts where tax life is used for accounting purposes. We depreciate based on useful life and considering the recoverable amount at the end. Tax doesn't do that. Your tax base may have been reset as a result of entering into a tax consolidated group. So the tax base in the entity itself doesn't reflect what the group's perspective of the tax base is. We may have deducted assets for tax, but capitalised them for accounting. In other cases, we capitalise them, they are deducted for accounting, but capitalised for tax. And a really good example of that would be equity raising costs. We just take them as a deduction against equity for accounting purposes, but in a lot of cases, there is a tax deduction phased over 5 years for those costs. And as people know, the requirement of the standard is that the tax expense follows where the accounting has gone. So the tax expense related to those equity raising costs follows it to equity. We do also have tax-only assets and liabilities. A number of these may arise in tax consolidated groups, but they wash their way through. And equally, we can sometimes have accounting-only assets and liabilities. One of the other issues I saw when I started looking at this one is just issues with, say, at-call loans. And again, I am not giving tax advice, and you need to talk to tax professionals for that one. But the ATO actually notes that related party or shareholder loans that don't have a fixed repayment term and are repayable on demand by a lender might either be debt or equity interest, or an equity interest in the entity for tax purposes. And there are carve-outs for turnover based on size. But if a debt is classified as an equity interest for tax purposes, it's going to be subject to CGT rather than revenue, and so it's not going to be not going to go up with the dividend stream. It's going to be a CGT event. One of my colleagues also sort of identified there's an issue that some of the miners are now seeing, that when an amount is invested into a company and is immediately written off for accounting purposes, so we've said it's unlikely that that loan will be recoverable. The tax office is now looking at a later point if that mine is successful or that exploration site is successful, and they reverse that impairment. The tax office in some cases is taking the perspective, well, you said it wasn't worth anything. The fact that you've now said it does have value, that's going to make it an equity return and subject to CGT, not being passed up as income. So it is something that people need to watch, and these are things that people should be discussing with their tax advisors before they put them in place, not after. Because once it's in place, it's very hard to change the consequences for it. So getting back to that comment that I made about the elections and other pieces before, it's identifying and documenting how is the tax base being determined, reviewing that on an annual basis, and if it changes, identifying why it's changed. So someone else can pick it up. People do move on, and equally, people do forget. So yes, you looked at it in detail last year, you know that there was something in there, but this year something else has happened, you can't remember what it was, and you completely forget it. So it's documenting and having that on file, working your way through. The requirements of the standard, and this is where it becomes relevant, is that the measurement of deferred tax liabilities and deferred tax assets shall reflect the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover or settle the carrying amount of its assets and liabilities. So it can and does change from period to period. And in some jurisdictions, the manner in which an entity recovers and settles the carrying amount of an asset or liability may affect either the tax rate or the tax base. So in that case, we use it consistent with the manner of recovery or settlement. And one of the things that AASB 112 does is it actually makes a rebuttable presumption in the case of investment properties carried at revalued amount. The fact that you're carrying it on a revaluation basis suggests that you expect to recover most of the value through sales. So it says you should consider that on the in our case, on a CGT basis. But if you don't want that to be applicable, you then have to rebut it. But you actually have to document. You should be documenting that rebuttal so that you know what's going on. Understanding in that case that although we've got it at fair value for accounting purposes, the tax base hasn't been shifting in the same rate, so the deferred tax balance is could be quite significant. Coming back to that myth that we had before. Recognition. Subject to certain recognition requirements for deferred tax asset, 112 requires us to recognise deferred tax assets from deductible temporary differences. They are subject to probability, and deferred tax liabilities arising from taxable temporary differences. And those deductible and temporary differences are the result of differences between the carrying amount of the asset or liability in the accounting records and the tax base. So recognising deferred tax assets or liabilities gives us a tax charge in the statement of in our profit or loss that corresponds to when we recognise the amounts in the other piece. But when we recognise it for tax purposes, it might be quite different. But again, it's a tax charge, and that is both current and deferred tax. Now, one of the things that a lot of people tend to miss is the issue around investments in subsidiaries, branches, associates, and interests and joint ventures. This is not the tax accounting of those entities. This is accounting for that interest in the parent entity. Not an issue in a tax consolidated group because effectively from a tax side, none of those entities exist. But if you are an entity who has an investment in a subsidiary and you're not in a tax consolidated group, yes, you've brought up the tax accounting of that subsidiary, and at a consolidated level, you've eliminated the interest in that subsidiary and shown its net assets and its profit. But in the parent entity, you have a potential deferred tax liability for any undistributed profits that are still sitting in that entity. That is applicable for a sub, a branch, an associate, or an interest in a joint arrangement. Now, there's an exemption from that recognition if the parent is able to control the timing of the reversal of the temporary difference, and it is probable that the temporary difference will not reverse in the future. Now, that is much easier to document when you're dealing with an investment in a subsidiary and potentially an investment in the branch, because that is just an extension of yourself. But one of the principles of an associate is that you do not control it. You have significant influence. And equally, in an interest in a joint arrangement, you have joint control. So in those circumstances, it is much less likely that you can actually meet the first branch of that exemption, that you are able to control the timing of reversal of the temporary differences. And it can actually have an impact on the tax rates or the tax consequences that you're bringing through. That is a deferred tax balance, that is a tax consequence for the parent, and it would not be eliminated on consolidation because it is a potential liability of the parent. The rules are slightly different when we deal with it in relation to a deferred tax asset. So in those cases where we have the interest in the subsidiary, branch, associate, or interest in a joint arrangement that can give rise to a DTA, we recognise that DTA for the differences, except to the extent the temporary difference will reverse in the future, and the taxable profit will be available against which the taxable difference can be utilised. So very different, because in this case, we don't need to be able to control it. We just need to be able to show that it's not likely to reverse in the foreseeable future. So they're not the same, and they are often missed because entities just go, well, I've done all my tax accounting, I eliminate that investment, I don't need to do anything more for it. No, the standard actually requires us to look through and see it. I referenced before when I was dealing with the myths that the recognition criteria for DTAs and DTLs are applicable whether you have a taxable income or a tax loss, and that comes straight from the standard. So for a DTL, it is always required, whereas the DTA is based on probability. This is accounting, so probability is more likely than not. That's as much guidance as we have. Deferred tax assets in an entity making tax losses are probable if they're expected to be available to offset deferred tax liabilities. Now, when we're dealing with tax consolidated groups, which is applicable for a lot of entities in Australia, those tax losses are assumed automatically by the headco in the period that they're actually generated, and they can be utilised by any entity in the tax consolidated group, recognising it's going up. So you can very much have taxable entities at one level, tax entities generating tax losses, that's gone up immediately. It offsets the tax liability for other entities, and the group keeps going forward. But then you need to understand, what is your tax funding arrangement in place? Are the entities subject to tax payable still going to make contributions up, or are they going to be equity contributions? So it's not as simple as just doing the accounting and understanding it from a single entity level. Now, another area that people have some issues with is the initial recognition exemption. Now, this exemption changed about 2 years ago. It got that third leg in B. So we recognise a DTL for all taxable temporary differences, except to the extent it arises from the initial recognition of goodwill, mainly because goodwill in most jurisdictions is not tax deductible, or the initial recognition of an asset or liability in a transaction that is not a business combination. At the time of the transaction affected neither accounting profit nor taxable profit or loss, and at the time of the transaction does not give rise to equal taxable and deductible temporary differences. But as it says there, and this is the paragraph out of the standard, when you're dealing with taxable temporary differences with investments in sub-branches and associates, there's slightly different rules. So what does this actually mean? It makes a difference if we're dealing with an asset acquisition as opposed to a business combination. The third leg, at the time of the transaction, does not give rise to equal taxable and temporary differences, was really brought in to account for the changes in accounting for leases, and also to deal in part for provisions, where we can be putting it into the cost of the asset, but we're also putting the liability on. One of the key places that we actually, one of the other ones might be government grants set up as deferred income. So we get it through there. But one of the key places that we've typically seen it, or one of the easiest examples in Australian jurisdiction, has always been motor vehicles. With the luxury car limit, and I think most people would agree it's no longer a luxury car limit given the cost of vehicles, the tax office caps the amount of costs that you can attribute to the motor vehicle and the depreciation that you're entitled to claim from a tax perspective. So from an accounting side, we recognise the asset as two components. We recognise the financial asset up to the extent of the tax cap, and the depreciation on the accounting side and the tax side give rise to temporary differences. And for the amount above the tax cap, there is no deferred tax consequences. And equally, if that motor vehicle was ever impaired, there are no deferred tax consequences from the component which is subject to the initial recognition exemption. But application of the exemption sometimes gets missed. People don't think it through, or they try and apply it where it's not applicable. The DTA, the initial recognition of a DTA is actually slightly different again, as it always works with DTAs. It is recognised for all deductible temporary differences to the extent that it is probable that taxable profit will be available against which it can be utilised, unless it arises from the initial recognition from a transaction which is not a business combination, affected neither accounting profit nor taxable profit, and at the time of the transaction did not give rise to equal taxable or deductible arrangements. So there is consistency through what they do, but it is still going to be slightly different. I touched on it before, but a little bit more information on what does at the time of the transaction does not give rise to taxable or temporary differences mean. It was amended so that it can't be applied to transactions such as leases and restoration obligations, because they aren't what it was intended for. The accounting has changed. 12 is a fairly old standard. It's still an IAS. So the accounting for right of use assets and lease liabilities, restoration provisions, other things is changing around it. So it keeps on, they keep on just amending pieces as to whether they want it to fall within the current rules as it sits. And throwing back to the Pillar 2 taxes, it has been that they've identified that top-up taxes are deemed to be an income tax. So it is covered in 112. So to throw it as something else, so a case where you might actually get a DTA arising on initial recognition of an asset is if you've got non-taxable government grants, which you've actually deducted from the cost of the asset. But for tax purposes, it's not been deducted from the asset's depreciable amount. Therefore, its tax base is different. So the carry amount of the asset is less than its tax base, and it will give rise to a deductible temporary difference. Government grants could also be set up as deferred income, in which case the deferred income and its tax base of nil is a deductible temporary difference. So it just comes down to where it actually goes. But the issue that we get when we apply this initial recognition exemption is that we can actually offset the DTA and the DTL that arise on initial recognition of the lease if our criteria work. And it might also be in some cases that our right of use asset and initial recognition is not exactly equal because we did put some other costs into it, but that just sort of works its way through. So the issue then comes down to what disclosures should you be including? This is an example of an entity that we have that actually has some very clear disclosures. In this case, it's actually an entity making tax losses. But we can see the loss before income tax. They've got a clear tax expense or benefit, depending on the year. And then down in the other comprehensive income, they have put as a separate line the income tax relating to the change in fair value of financial assets. It is actually a requirement when we're disclosing items in other comprehensive income to show them net of tax. And it works well to actually show it on the face, because in this case, with changing the fair value of financial assets, as you appreciate, they can be moving in quite, they can move quite a lot over different periods. So in one case it was positive, in one case it was negative, and the taxes were washing around as well. And in both cases, we can see both of those disclosures are throwing off to note 2.3. So they're throwing it to one single place where we're going to see a reconciliation of what's actually going through their tax expense. So in that note 2.3, they've worked it down, and they've correctly shown us that their income recognised outside of profit or loss is deferred tax credited directly to equity and deferred tax credited to OCI. I didn't pick it up, but they also had a note disclosure that shows their tax expense, both for current and deferred. And then on their reconciliation between their loss for income tax and tax expense, they have given us the detail of those temporary differences. So it's not just a lump. Some of it relates, in this case, to share-based payments, to tax losses that they've taken off book, and to temporary differences they've derecognised. Other is very small. It's not the majority of them. And they've had a specific reversal of DTL on exploration costs. But that number then ties back to, as I said before, the numbers that they've got on the face of their statement. I didn't pull up the comparative period, but here is their movement in deferred tax balances. And again, they've gone from their opening balance, they've told us that they recognised it in profit or loss, equity or other comprehensive income. We've got the specific balances which then tie back to the relative respective notes with provisions, share issue costs, how much have we derecognised, what DTAs have we recognised, what DTLs have we got, what's our net position, which is that they've recognised DTAs to the extent of the DTLs and they've got nil. But the impact of doing that has washed through in the P&L, equity or other comprehensive income. They've then got very specific disclosure about their unrecognised deferred tax assets as to what those balances are and what are their unrecognised tax losses. And they are clearly done at the tax rate with the detail of, in order to recoup the carry forward tax losses, either the continuity of ownership or same business test must be done. And at this point, the majority of losses carried forward are under the continuity of ownership test. But anyone picking up these financials can actually see what is coming through and why it's coming through. And then their accounting policy is also very clear. So one of the issues that was touched on in last month's webinar was spring cleaning your financial statements. And these people have actually worked through their accounting policy, and what they're telling us are the relative elements of it. So they've given us some detail on the DTA because for them, it's actually a large balance. So they've been specific on it. But they've gone through and given us the company derives future assessable income of a nature and amount sufficient to pull it through, that they continue to comply with the conditions, and there are no changes in tax legislation. So those are the specific things which are relevant to them. Their piece then under measurement and recognition is not giving us all the detail out of 112 that anyone who wanted to go and read it would. They've told us specifically that it's been put through based on the jurisdictions that they operate in. It's where it's been accounted for in the profit or loss or the other statements, how they've accounted for it. So it's accounted for in respect of the differences between all taxable temporary differences, not recognised for investments in subs, because they are able to control the timing of the reversal of the temporary differences, and it's probable that they will not reverse, and that they have been offset. So it's the relevant information if someone was trying to understand how they've tax accounted to actually see what they're doing. And Kevin, I think I'll throw back to you to talk about tax and sustainability, because I'm pretty sure most of the people listening today did not think I could get it back to play with that one as well.
Absolutely, Kate, and I'll congratulate you on actually finding the link to tax and sustainability, although to be fair, it's probably not hard to find it, because as you can see from Kate's presentation to this point, tax accounting or tax effect accounting has moved very clearly from the realm of, shall we call it, a technical calculation, to something that has become really important tool in good governance. And what we have on the screen, and Kate found this for the webinar today, is essentially the ATO's position on tax and where it fits into a well-functioning society. And the ATO probably did the hard work for us to find the link to sustainability, because in their view, tax is, shall we call it, the silent T in ESG. What that really means is tax plays its part in paying for a lot of the S and the E in ESG. And put another way, in the middle of the slide there, this is quoting from the ATO itself: a company that avoids its compulsory contribution to S by way of taxes has not truly achieved its ESG framework. And they went as far as saying, no matter how much voluntary contribution it boasts about in its disclosure. So that's a really nice way to bring it all together and say, T, or tax, is really an important part of ESG and sustainability. Everybody needs to pay their fair share, because that fair share pays for a lot of the S in terms of infrastructure, social programs, and so forth. And it's really part of good governance. Now, jumping onto the next slide, and I'll show you what we mean by this, is disclosing your effective tax rate is actually an important part of disclosing your ESG credentials. This is an example of effective tax rate disclosure shown in Australia, and then as part of the entities or the corporation's global operations. And what they're disclosing here is their effective tax rate. Bringing it back to Kate's point earlier in the presentation, that effective tax rate, which includes the impact of current and deferred tax, is the measure of our silent T contribution to ESG. This is a clear disclosure of what that looks like, and notice the clear link to tax transparency report at the bottom, which is essentially a link to ESG and to the ESG data center. The point being here is that this entity, and it's Orica, because we've given the name at the bottom here, is clearly articulating its contribution as a tax-paying entity or corporation, and its share towards sustainability and environmental and social good governance. Now, the important thing here is that in order to do this disclosure, in order to come to these calculations, they would have had to have good systems and controls around their calculations for deferred tax or tax effect accounting. Even if they were loss-making, I'm not sure they are, I can't say that for sure, but even if they were loss-making, and taking it back to the disclosures of the example that Kate had earlier on disclosures, that was an entity that had massive tax losses, but was still maintaining its calculations, understanding where its deferred tax was coming up from, because that had an impact on its effective tax rate. And that is the important measure that's emerging out there. I think that's probably where we'll leave it today. I mean, Kate, I'll bring it back to some of the things you made, or the points you made on the myths and the initial recognition exemptions. My take from that is that we can almost easily get the calculations right on some of the easy things, like perhaps, I don't know, accounts receivable and investment property. But where this goes awry is when you start to lose track of things like investments in subsidiaries, associates, and joint ventures, where you lose track of the fact that you actually have a deferred tax impact in the parent entity that's not part of a tax consolidation group, and that effective interest rate is quite, effective tax rate is quite different to perhaps what the group's effective tax rate might be. And those are the sort of blind spots in the way we approach this as a profession. Last message that I took from Kate's session as she spoke was, make sure you have the right people involved in the calculation. We've said this a few times now. You know, it's not just a calculation that's done by somebody at the end of the year. Make sure your accounting professional and your tax professionals who are involved in these calculations are sufficiently qualified and competent to actually bring together the calculations so that you can actually get to the right answer, because it's not just your investors and your stakeholders and your auditors looking anymore. Even the ATO is asking for schedules on tax and tax effect accounting in some circumstances. So it is a new world out there. Kate, did I miss anything that you'd like to add, just in a summary?
I was going to say, I'll just throw back to it that one of our colleagues formerly worked for ASIC, and I discussed it with her, and she noted that the tax disclosures are something that ASIC does look at in identifying whether they want to look further into financials, and they are looking to the amount of detail or lack of detail. So going back again to effective tax rates, but also to tax disclosures, that the more someone tries to hide something, the more it actually puts a red light on it.
That's right.
Sort of, if you don't do a disclosure, it sort of puts a flashing light.
That's right. And hiding it, sometimes you don't know you're hiding it because you think, I have accumulated losses, I don't have deferred tax, it's not important.
No one cares about me.
That's the same thing. Absolutely the same thing. All right. Well, Kate, thank you very much for that. I truly enjoyed that as well, and I hope the audience did as well.
I think you have a few more slides, Kevin.
I do have a few more slides, so I do need assistance. So what I'll write up with is don't forget that we have a vast array of corporate reporting topics on the website. I'll come to the sustainability ones now, which is on the slides, but just having a look while Kate was talking on this particular topic on our BDO corporate reporting topics, I did actually notice that we actually have 3 online training modules on income taxes. One of them is a purchase module, which is a high level. It's a purchase module, so it's a paid download or seminar. Where you can actually get a high level summary of an income tax standard. But we do have free modules on basic and advanced deferred tax topics, which is actually free download off our website. You can just go and have a look, which by the way, BDO's website has been updated and amended as of Monday last week in part of our rebranding that we're moving towards, but it's also improving functionality. So hopefully you will see that when you go onto our website, that it's a lot easier to navigate and to find some of these important resources, most of which are actually available freely. In terms of sustainability then, in terms of services, we're putting this up there because linking it to the sustainability message we had previously, BDO's core services on sustainability are actually starting to emerge in these 5 blocks. And this is because of where the industry is moving. Just remember that there is a Treasury consultation paper out there in terms of government's intention on where they plan to move with climate-related financial disclosures, and we are expecting there to be legislative change early in the new year. Around that, the sorts of services we are offering to support that transition are things like carbon footprint measurement under the GHG protocol, strategy in terms of decarbonisation, and that moves also then into just broader sustainability strategy. We're talking risk assessment, risk and opportunity registers, materiality and gap assessments, and then the broader sustainability reporting. And let us just make the note again that tax and tax effect accounting is now part of a sustainability reporting metric because it's paying your fair share, the silent T in ESG, and obviously moving that into assurance and pre-assurance engagements. There is actually extended suite of sustainability services that BDO offers, extending from sustainable finance through to communities and supply chains, human capital through our people advisory, and then also just plain learning and development, which I'll bring it back to our topics online. There's a lot of content on our website that can help with your learning and development. And can I just say on learning and development, I had a question yesterday in a forum about where do boards start with sustainability? And I want to say that before you jump into any sort of strategy development, just educate yourself. And so please reach out to the BDO website for these insights, not only on sustainability, but also our corporate reporting insights. So we've got some links on here. We have our insights, which are our monthly newsletters, as well as other sort of thought leadership. You can register to receive that. It's all free. It'll come into your inbox through the registration. So don't forget to register for that. And then back to our education and training. We've got ESG webinar series. We've got the TCFD e-course, which is a free RISE material that can actually help you on the TCFD requirements, which forms the basis of the financial disclosures in this area. And of course, the webinars we're on here, it's not on the slide now, but the webinars that we're giving you today, these are all free, including the ones that go back years and years and years. And we have done sessions on tax effect accounting and deferred tax before. So there's a lot out there. If you didn't get the basics today, but you got more of the higher level governance and strategy messages today, you can go back to the basics of deferred tax and tax effect accounting, and we do have material. Right, so I'll wrap up then just reminding you of who our corporate reporting leaders are. Myself, Ashley Woodley in Perth, Aletta, who's away at the Rugby World Cup, and we're a little bit jealous about that because she did actually go to the South Africa-France quarterfinal, and it was very tense, and I don't actually think she almost made it through. It was just too much, but she did actually go to the stadium and she actually enjoyed that. Etienne also in Melbourne, Clark and Lynn in Brisbane and in Adelaide, and myself, of course, in Sydney. And then with Kate, you'll be on the next slide, Kate, our broader IFRS and corporate reporting team, including Kate on there, who's based in Melbourne. The team keeps moving and changing and developing because a lot of new new people coming in, including on our last slide, which is sustainability, the contacts there, and that team is also growing across the country to deliver various of those services we referred to before. So we're going to give you 6 minutes back today, which is unheard of on a webinar. So Kate, I'm going to say that the one thing you can take away today is you finished before Aletta and I could. So get the message across and get it across succinctly. Well done. It's gone 5-2 now, so we'll say thank you, Kate, for joining us. It was very informative. And to our audience out there, have a good day. We'll see you next time. November, the penultimate month of the year. Can you believe it? See you next time and have a good day.
Thank you. Bye, guys.